Why 99% of ETFs are garbage and how to find the top 1%. Let's be honest, 99% of ETFs are completely useless. They are a marketing bubble designed to do one thing: drain money from your pocket. Today I am going to expose the hidden traps inside these funds. And more importantly, I will show you how to find the top 1% that are actually worth holding in your portfolio for the long haul. An ETF, or exchange traded fund, is a fund that trades on an exchange, just like a stock. You buy one share and you get a whole basket of assets, stocks, bonds. Here is what they promise you: instant diversification, low cost, simplicity and liquidity. But here is the catch: these promises exactly how they trap you. Behind those beautiful slogans are some very pragmatic and costly pitfalls. Thematic ETFs, cybersecurity, space explosions, green energy. It all sounds exciting, right? But here is the hand truth. Thematic ETFs are almost always created after a trend has already peaked. You're buying in just as the bubble is about to pop. Historically, these funds often underperform the broader market for the first 5 years or more. This isn't investing, it's betting on the next big thing, when you should have been there yesterday. Invisible robbery, fees, spreads, and hidden costs. Your biggest long-term enemy is the fee you barely notice. Niche thematic ETFs can have expense ratios of 0.5%, 1%, or even higher. Over a decade, that eats a massive chunk of your returns. But that's not all. If a fund isn't traded often, it's illiquid. The spread, the gap between the buy and sell price, can be huge. You're paying a hidden tax the second you buy or sell. Pragmatic word advice. The biggest funds tracking major indexes today have fees as low as 0.03%. Anything over 0.2% for a same index fund should be a major red flag. The illusion of diversification. They tell you buy the index and you're diversified. It sounds smart, but it's often a lie. Take the S&P 500. You think you own 500 companies, but in reality, a handful of tech giants, the Apples, Microsofts, and Amazons, make up a huge portion of the index. Your diversified fund is actually making a massive, concentrated bet on big tech. Your diversification isn't an illusion, especially when one sector or region gets overheated. These ETFs promise to double your returns. Scene number 4. Overly complex products. Leveraged, inverse, and smart ETFs. These ETFs promise to double your returns, make you money when the market falls, or use smart strategies. But due to complex mechanics like daily rebalancing, they suffer from volatility decay. On a long-term chart, they often bleed value, even if the market goes sideways or you correctly guess the direction. These are dangerous tools for potential day traders, not long-term investors. Holding them for more than a few days is a near guaranteed way to lose money. The black box, synthetic ETFs and provider risk. Not all ETFs physically own the assets they track. Some are synthetic and use derivatives like swaps to replace index performance. This introduces counterparty risk. If the bank providing the swap goes bust, investment could be in serious trouble. And the provider itself matters. A small, proven ETF manager would go out of business. I stick with the titans of the industry: Vanguard, BlackRock, iShares, and State Street SPDR. They are the bedrock of the market, with trillions in assets and a reputation for transparency and low costs. They are too big to fail, and that's a pragmatic bet I'm willing to make. My strategy: how to find the 1% of ETFs worth owning. Okay, so 99% is garbage, but the remaining 1% are the most powerful wealth-building tools ever created. Here is my pragmatic framework for building a portfolio with them. The core of your portfolio, broad market ETFs. My foundation is built on ETFs that track the entire global market, like the MSCI World or FTSE All World Index Fund. For a US-centric approach, a core holding in something like VOO, S&P 500, or QQQM, Nasdaq 100, S&P 500, Nasdaq 100 is also fantastic. This gives you true diversification across countries and sectors, settling holdings, counter ETFs. If you have a strong belief in the economy of a specific country, like Germany, Japan, or emerging markets, you can allocate a small tactical portion of your portfolio here. Tactical bets, sector ETFs. Only touch this if you have deep knowledge of a sector, like technology, healthcare, or energy. Think of this as a bet, not a core holding. It's often better for shorter-term traders. And the 70 net government bond ETFs. This is your portfolio shock absorber. High-quality government bonds like US Treasuries often rise when the stock market crashes. The pragmatic strategy is to sell some of these bonds when they are high during a panic and use the cash to buy your core stock ETFs at a deep discount. I did it before a few times, by the way. And here is my portfolio golden rules for choosing any ETF. Provider and reputation. I only trust the giants, Vanguard, BlackRock, State Street. They are a constant war to lower fees for investors, and I even diversify among them, expense ratio and liquidity. For broad market ETFs, I will not pay more than 0.2%, and I aim for under 0.1%. The lower the better, and I check the trading volume. High volume means a tight spread and less risk. Conclusion. So let's recap. Most ETFs are making traps, not wealth-building tools. Thematic, complex, and high-fee funds are designed to fail you in the long run. A winning strategy is simple. Build a core portfolio with broad market ETFs and then pragmatically and position in countries, sectors, or bonds based on your goals. And your ultimate filter is always a trusted provider, a rock bottom fee, and high liquidity. Now, I want to hear from you. What ETFs are already in a portfolio? Drop their tickets in the comments below so we can discuss them. If you enjoyed the video, leave a like and subscribe if you're new. Bye bye.